China's economic disaster, the real estate crisis. Overview of the crisis. China's real estate crisis emerged as a significant economic disaster following the 2021 default of the Evergrande Group, one of the country's largest property developers. The crisis has triggered a chain reaction affecting numerous developers, financial institutions, and the broader economy. This report outlines the key events leading to the crisis, the impact on various stakeholders, and the ongoing repercussions. Timeline of events and developments. 2000s to early 2010s, the rise of the real estate bubble. 2000s, local governments in China became increasingly reliant on revenue from land sales and infrastructure investments, leading to a significant rise in real estate prices. 2005 to 2009, land prices soared, increasing threefold in just 4 years. The Evergrande Group, founded in 1996, grew rapidly, becoming the world's most indebted property developer. 2020, regulatory changes. August 2020, the Chinese government introduced the 3 red lines policy to limit developers' debt levels. This regulatory framework aimed to stabilize the housing market and curb speculative investments. 2021, the default of Evergrande. August 2021, Evergrande warned of looming cash flow issues, leading to a drastic decline in its stock value and increasing panic among investors. September 2021, the company defaulted on its $300 billion liabilities after failing to make a scheduled payment, marking a critical point in the crisis. The Chinese government intervened by taking control of some of its assets to protect homebuyers. 2022, escalation of the crisis. 2022, Evergrande's financial situation deteriorated further, with numerous homebuyers starting to boycott mortgage payments. This resistance highlighted the growing distrust in the real estate sector and exacerbated the crisis. 2023, continued decline and additional defaults. July 2023, Evergrande reported staggering losses of approximately $66 billion, further underscoring its financial woes. August 2023, the company filed for bankruptcy protection in the U.S. as part of its restructuring efforts. September 2023, Hui Ka-yen, Evergrande's chairman, was detained by authorities for suspected illegal activities. 2024, liquidation and regulatory actions. January 2024, a Hong Kong court ordered the liquidation of Evergrande, stating that the company lacked a viable restructuring plan. The stock price had plummeted to record lows, reflecting the deepening crisis. March 2024, the China Securities Regulatory Commission penalized Evergrande for overstating its revenue by nearly $30 billion in previous years. Key stakeholders affected. Homebuyers. The crisis has severely impacted millions of homebuyers who invested in Evergrande's projects. Many have found themselves in limbo, facing delayed construction and uncertainty about whether they will receive the homes they paid for. The nationwide mortgage boycott in 2022 highlighted the widespread dissatisfaction and fear among consumers. Property developers. Apart from Evergrande, other major developers like Country Garden and Kaisa Group faced financial distress. Country Garden reported significant losses and struggled to meet bond payment obligations, raising fears of its potential default. Financial institutions. Banks and investors with exposure to Evergrande's massive debts suffered significant losses as the crisis unfolded. The interconnectedness of the real estate sector with China's financial system has raised concerns about systemic risks and contagion effects within the economy. Conclusion. The Chinese real estate crisis, primarily triggered by Evergrande's collapse, has exposed the vulnerabilities in the nation's financial system, characterized by high leverage and inadequate regulatory oversight. The repercussions of this crisis are likely to resonate for years, prompting the Chinese government to reconsider its economic strategies and regulatory frameworks to prevent a recurrence. As the situation evolves, the focus will be on stabilizing the housing market and restoring confidence among investors and consumers. The current economic disaster in China, particularly regarding the real estate sector, is marked by a series of counterintuitive dynamics that challenge conventional economic expectations. Here are some of the key counterintuitive aspects of this crisis. 1. High debt yet stagnant growth. Typically, high levels of corporate debt are expected to stimulate growth through increased investment. However, in the case of Chinese real estate developers like Evergrande, excessive debt has led to a liquidity crisis and halted growth. Instead of fueling expansion, the leverage has made firms vulnerable to market corrections, leading to defaults and a slowdown in the broader economy. 2. Government intervention backfiring. The Chinese government's attempts to rein in the property bubble through the three red lines policy aim to stabilize the market by limiting developer borrowing. Ironically, rather than stabilizing the market, this policy precipitated a crisis that caused many developers to default, leading to a broader economic downturn. This demonstrates that regulatory measures can have unintended consequences, exacerbating the very issues they aim to mitigate. 3. Homebuyer boycotts against developers. In a surprising twist, many homebuyers began to boycott mortgage payments in response to construction delays and defaults by developers. This action undermines the traditional notion that homebuyers are wholly reliant on the developers to fulfill their contracts. The boycotts reflect a shift in consumer power and sentiment, indicating that buyers are willing to take drastic measures to protect their interests, potentially leading to further financial strain on developers. 4. Empty apartments amid high demand. Despite estimates suggesting there are about 60 to 80 million empty apartments in China, the government has historically promoted property ownership as a pillar of wealth creation. The existence of such a high number of unoccupied homes contradicts the narrative of a booming real estate market and highlights a misallocation of investment. This situation raises questions about the sustainability of a model that relies heavily on real estate as a driver of economic growth. 5. Shadow banking crisis. The crisis has also revealed vulnerabilities in China's shadow banking system. These institutions, designed to provide credit where traditional banks do not, have become heavily intertwined with the troubled real estate sector. The failure of these shadow banks is counterintuitive to their intended purpose, which was to provide alternative financing solutions and mitigate risks in the conventional banking system. 6. Perceived recovery amidst ongoing decline. Despite alarming reports of declining property sales and increasing defaults, there have been moments of market optimism fueled by government pledges to stabilize the economy. This optimism seems misplaced as the underlying issues of overleverage and declining consumer confidence remain unaddressed. The cyclical nature of investor sentiment can lead to temporary surges in stock prices that do not reflect the fundamental economic realities. 7. Government's mixed signals. The Chinese government's mixed messages regarding real estate policies, promoting home ownership while simultaneously tightening credit, create confusion among investors and consumers. This lack of clarity can exacerbate market instability as stakeholders are unsure of the long-term direction of policy, leading to hesitancy in investment and consumption. 8. Rising youth unemployment. The ongoing crisis has led to significant youth unemployment, which is paradoxical in a country that historically has seen rapid economic growth and job creation. The disillusionment among young people regarding job prospects contradicts the expectations of a thriving economy, suggesting that the traditional pathways to economic success and stability are being eroded. 9. Foreign investment retreat. The crisis has led to a retreat of foreign investment, which is counterintuitive given China's status as a global economic powerhouse. The flight of foreign capital indicates a loss of confidence in the Chinese market, which typically would be expected to attract investment due to its size and potential for growth. 10. Crisis as opportunity. While the crisis has caused immense suffering and financial loss, it also presents opportunities for reform in China's economic structure. The collapse of unsustainable business models could pave the way for more responsible lending practices and a shift towards an economy less reliant on real estate. However, this potential for positive change is often overshadowed by the immediate negative impacts of the ongoing crisis. In summary, The unfolding real estate crisis in China exhibits numerous counterintuitive dynamics that challenge traditional economic theories and expectations. The interplay between high debt levels, government intervention, consumer behavior, and structural vulnerabilities in the financial system creates a complex scenario that continues to evolve. Understanding these counterintuitive elements is crucial for grasping the full scope of China's economic challenges and the potential paths forward. China's economic disaster, the real estate crisis. The ongoing real estate crisis in China has roots that extend deep into its economic structure with significant implications that many observers may overlook. The crisis, primarily ignited by the Evergrande Group's default in 2021, has not only exposed vulnerabilities within the real estate sector but has also laid bare the intricate connections between local government finances, shadow banking, and the broader economy. Here, I will focus on critical aspects of the crisis that are often overshadowed in general discussions, providing insight into their significance. 1. The role of local governments. One crucial element of the crisis is the dependency of local governments on real estate for revenue. Local governments in China have historically relied on land sales and property development as their primary source of income. This financial model, which began gaining traction in the early 2000s, has led to an over-reliance on the real estate sector. As land values soared, so did local government debts, creating a precarious situation. The significance of this dependency cannot be overstated. It underscores a systemic risk within China's economic framework. When real estate falters, local governments face severe financial strain, leading to potential defaults on public projects and services. The crisis has already prompted a slowdown in infrastructure investment, which could have long-term ramifications for economic growth and stability. 2. Shadow banking and risk exposure. The shadow banking system in China has emerged as another often underestimated factor in the crisis. Shadow banks, which operate outside the traditional banking system, have provided financing to many real estate developers, including Evergrande, through wealth management products, WMPs, and trust loans. These instruments often come with high risks as they are not subject to the same regulatory scrutiny as traditional bank loans. The interconnectedness of the shadow banking system with real estate developers means that the fallout from the crisis could extend beyond the property sector, potentially triggering a broader financial contagion. Many investors in WMPs are individual retail investors, exposing them to significant losses. The lack of transparency and regulation within this sector heightens the risk of widespread defaults, which could lead to a loss of confidence in the financial system. 3. Impact on homebuyers and social stability. The crisis has led to a significant backlash from homebuyers, many of whom are now boycotting mortgage payments due to stalled construction projects. This movement illuminates the human aspect of the crisis. Beyond the financial metrics and corporate defaults lies the reality of families' aspirations and investments being jeopardized. The significance of this social unrest is profound. If homebuyers continue to resist mortgage payments, it could exacerbate the liquidity crisis for developers and lead to further defaults. Moreover, widespread discontent among homeowners can lead to broader social instability, challenging the government's ability to maintain public order and confidence in its economic policies. 4. Government intervention and policy responses. The Chinese government's response to the crisis has included regulatory measures such as the 3 red lines policy, which aims to limit developer leverage. While these measures are intended to stabilize the market, their implementation has also led to unintended consequences such as a further slowdown in property sales and construction activities. An often overlooked aspect of the government's intervention is the balancing act it must perform between stabilizing the real estate market and addressing the potential for moral hazard. By intervening to bail out certain developers, the government risks encouraging reckless behavior in the future, as developers may continue to take on excessive risk with the expectation of being rescued. The long-term implications of these interventions could undermine the credibility of regulatory frameworks in China. 5. The broader economic implications. The implications of the real estate crisis extend beyond the property sector, influencing the entire economy. The construction industry is a significant driver of employment and economic activity in China. As construction halts due to financial constraints, job losses may follow, impacting consumer spending and overall economic growth. Moreover, the crisis has already contributed to rising youth unemployment, as many young people are employed in the construction and real estate sectors. This demographic challenge could have lasting consequences for social cohesion and economic dynamism, as disillusioned youth may struggle to find stable employment in an increasingly uncertain job market. 6. Potential for future crises. The real estate crisis serves as a warning about the potential for future economic disasters. The vulnerabilities exposed during this crisis, particularly the reliance on debt-fueled growth and the precarious nature of shadow banking, are indicative of deeper structural issues within the Chinese economy. Without significant reforms to address these systemic risks, the likelihood of similar crises arising in the future remains high. In conclusion, the real estate crisis in China is a multifaceted issue that transcends mere corporate defaults and financial metrics. By examining the overlooked aspects such as local government dependency, shadow banking, social impacts, government responses, and broader economic implications, we gain a clearer understanding of the crisis's significance. Addressing these challenges will require comprehensive reforms, innovative policies, and a nuanced approach to economic management to ensure a stable and sustainable future for China. 1. Impact of the Evergrande crisis on the real estate market. The failure of Evergrande Group in 2021 marked a pivotal moment in China's real estate sector, exposing the vulnerabilities of high leverage and unsustainable growth practices. The company's default, which stemmed from the government's 3 red lines policy, not only led to its own financial collapse but also triggered a ripple effect across the entire industry. Other major developers like Country Garden and Kaisa Group faced similar financial distress, resulting in widespread defaults and a significant slowdown in property sales. This crisis has revealed the extent to which local governments relied on land sales and real estate development for revenue, underscoring the systemic risks inherent in the sector and prompting a re-evaluation of regulatory approaches. 2. Regulatory responses and market reactions. In response to the unfolding crisis, the Chinese government implemented stringent regulations aimed at curbing excessive borrowing among developers. The 3 red lines policy was a critical measure that restricted the amount of debt property developers could incur. However, this regulatory tightening was met with mixed reactions in the market. While it aimed to stabilize the economy and prevent further financial contagion, it inadvertently led to decreased investor confidence and a decline in property prices. The market reaction highlighted the challenges of balancing regulatory oversight with the need to maintain liquidity and growth within the real estate sector. 3. Socioeconomic consequences and public sentiment. The real estate crisis has had profound socioeconomic impacts, particularly on homebuyers and investors who purchased properties as investments rather than places to live. Widespread mortgage payment boycotts emerged as frustrated buyers sought to protest the lack of project completions and delivery delays. This discontent reflects a broader sentiment of distrust towards real estate developers and the government, as many individuals found themselves in precarious financial situations due to the inability to secure their investments. The crisis has exacerbated issues such as youth unemployment and has raised questions about the future of the housing market in China, leading to potential long-lasting changes in consumer behavior and attitudes toward property ownership. 4. Future implications and economic outlook. The ongoing fallout from the real estate crisis poses significant implications for China's economic trajectory. As the government grapples with stabilizing the property market, it faces the challenge of addressing local government debts, which are heavily intertwined with the fortunes of real estate developers. The potential introduction of a property tax and the need for fiscal reforms may reshape the landscape of real estate investment in China. Additionally, the crisis serves as a cautionary tale for global investors, emphasizing the importance of risk assessment and regulatory environments when engaging with emerging markets. Looking ahead, the resolution of the crisis will require careful navigation of both economic policies and public sentiment to restore confidence and promote sustainable growth in the real estate sector. 1. The 2008 financial crisis. United States. The U.S. experienced a significant financial crisis that stemmed from the collapse of the housing bubble. Similar to China's real estate crisis, the crisis was characterized by high levels of mortgage debt, risky financial products, and inadequate regulatory oversight. The collapse of major financial institutions such as Lehman Brothers triggered a global recession. The crisis revealed the dangers of excessive leverage in the housing market and led to widespread foreclosures, substantial job losses, and significant government intervention to stabilize the economy. 2. The Japanese asset price bubble. Late 1980s, early 1990s. In Japan, a massive asset price bubble developed during the late 1980s. Driven by excessive speculation in real estate and stock markets. When the bubble burst in the early 1990s, it resulted in a prolonged economic stagnation known as the lost decade. Like China's current situation, the Japanese economy faced severe repercussions due to high levels of corporate and household debt, leading to a banking crisis and a significant drop in real estate prices. The Japanese government struggled to manage the fallout, and the economy took years to recover. 3. The Eurozone debt crisis. 2010 to 2012. Following the global financial crisis, several Eurozone countries, particularly Greece, faced severe debt crises. The economic turmoil was exacerbated by high public debt and deficits, coupled with a reliance on borrowing. The crisis led to bailouts by international lenders and significant austerity measures that had widespread social and economic repercussions. Similar to the Chinese real estate crisis, the Eurozone crisis highlighted the risks associated with unsustainable debt levels and the interconnectedness of financial markets, leading to a broader economic slowdown in Europe. Future outlook, predictions for China's real estate market post-crisis. The Chinese real estate market has been in turmoil since the Evergrande crisis began in 2021, leading to widespread financial distress among developers and significant economic repercussions. As we look into the future, several key predictions can be made regarding the trajectory of China's real estate sector and its broader economic implications. 1. Market stabilization and recovery. In the short to medium term, 2025 to 2027, it is expected that the Chinese government will implement measures to stabilize the real estate market. This could include increased regulatory support. The government may continue to relax the 3 red lines policy, allowing developers more leeway in borrowing to complete unfinished projects. This could lead to a gradual recovery in housing supply and demand. Fiscal stimulus. Expect more aggressive fiscal policies aimed at stimulating the economy, particularly through infrastructure development and housing projects. This could include tax incentives for homebuyers and subsidies for first-time buyers to boost demand. Market confidence restoration. As developers begin to resolve their liquidity issues and complete projects, consumer confidence may return, leading to an uptick in housing sales. 2. Shift in consumer preferences. The crisis has altered consumer perceptions regarding property ownership. Future predictions include preference for affordable housing. There will likely be a shift towards more affordable housing options as buyers become more price sensitive in the wake of the crisis. Developers will need to adapt their offerings to meet this demand. Focus on quality and sustainability. Consumers may prioritize quality and sustainable building practices over sheer size or luxury, prompting developers to innovate in construction methods and materials. 3. Impact on shadow banking. The real estate crisis has heavily impacted China's shadow banking sector, which has significant exposure to property loans. Predictions for this sector include increased regulation. The government is expected to tighten regulations on shadow banks to mitigate risks and enhance transparency. This could lead to a consolidation in the sector as weaker players exit the market. Reevaluation of risk models. Financial institutions will likely reassess their risk models and lending criteria, leading to a more cautious approach to financing real estate projects. 4. Continued financial contagion risks. Despite efforts to stabilize the market, the potential for financial contagion remains a concern. Legacy debt issues. Many developers will still grapple with legacy debts, and the risk of defaults may continue to linger. This could have spillover effects on banks and financial institutions, leading to a prolonged period of economic uncertainty. Investor sentiment. Foreign and domestic investors may remain wary of investing in the Chinese property market, leading to reduced foreign direct investment (FDI) and a cautious approach to new projects. 5. Long-term structural changes. The crisis has exposed underlying structural issues in the Chinese economy and real estate market. Focus on urbanization and infrastructure. The government may prioritize urbanization and infrastructure development in lower-tier cities to stimulate economic growth and alleviate housing pressures in major urban centers. Introduction of property tax. There is the potential for the introduction of a property tax aimed at curbing speculation and ensuring a more sustainable real estate market. This could also address local government debt issues tied to land sales. 6. Geopolitical and economic influences. China's real estate market will not operate in a vacuum. It will be influenced by global economic conditions. Global economic conditions. Economic slowdowns in major markets including the US and Europe could impact Chinese exports and consequently domestic demand for housing. Geopolitical tensions. Ongoing geopolitical tensions could affect investor confidence and international trade, leading to further economic challenges. Conclusion. The future of China's real estate market remains uncertain but is likely to be characterized by a gradual stabilization and recovery phase driven by government intervention and changing consumer preferences. However, risks associated with legacy debts, financial contagion, and global economic conditions will continue to pose challenges. Policymakers must remain vigilant and proactive in addressing these issues to foster a sustainable recovery and avoid a recurrence of the crisis.